as the Federal Reserve decided to raise interest rates by 25 basis points at the regular meeting of the Federal Open Market Committee on July 26th, local time. The U.S. base rate was adjusted to 5.25 to 5.50%. The Fed kept interest rates unchanged in June, while continuing to raise interest rates 10 times in a row from March 2022. At the time, Chairman Powell hinted to more rate hikes within the year, so this rate hikes was considered fait accompli. However, inside and outside the market, it is thought that this will be a last rate hike. Chairman Powell said at the press conference that day that the Fed's economic team no longer expects a recession in the United States, but later a press conference by Fed Chairman Jerome Powell fueled investor confusion. Chairman Powell did not comment on whether this would be the last rate hikes, but noted that further hikes could be made if necessary. I can definitely say it at our September meeting that we may raise rates further, he said, but it's also clear that we might keep rates on hold. Depending on how the data goes, we will carefully analyze economic indicators at each FOMC meeting in the future to decide whether to raise interest rates, he said. Powell also made it clear that there is no interest rate cut within the year. We'll cut rates when it's comfortable, but not this year. Powell said, inflation will not return to the 2% inflation target until 2025. He said, this remark was the most hawkish remark at the press conference that day. However, although the U.S. Federal Reserve System raised the benchmark interest rates by 0.25 percentage points, led the interest rates in the overall bond market turned downward at once. This rate hikes was already predicted by the market. In fact, this reflected the expectations of America's last step. On July 27, the 3-year Treasury bond yield, which serves as the indicator of the bond market, was 3.587%, down 4 BP from the previous day. In most of the maturities of government bonds, including 3-year Treasury bonds, 2-year 3.627%, 5-year 3.588%, 10-year 3.637%. The decline in interest rates was remarkable. As for corporate bonds, the credit rate AA and BB interest rates based on 3-year maturities fell by 3.9 BP to 4.374% and 10.774% respectively. According to the Chicago Mercantile Exchange Worldwatch, which compiles the U.S. benchmark interest rate market outlook, interest rate futures market participants see an 80% change of the rate freeze at the FOMC meeting in September. 64% of prospects that the final interest rate within the year will be at the same level as the current 5.25 to 5.50%. Despite the Fed rate hike on the same day, the domestic bond market shows the bullish trend and shows a downward trend in interest rates because of the view that this would be the last rate hike. While the possibility of the consecutive hikes in September is not high, the next meeting will be held in November or December. Considering the time lag in monetary policy, it will be more affected by tightening than the current one, and the Fed rate hike cycle appears to be over. If there is no surprise by the FOMC in September, we believe the message is that at least there will be no acceleration in rate hikes. The Bank of Korea has maintained the base rate at 3.5% for more than half a year after rising interest rates in January this year. Due to the Fed interest rate hikes, the gap between the US and Korea interest rates has widened the level of 2 percentage points based on the upper level, which is the largest reversal in history. However, weight is placed on the fact that the possibility of capital outflows following a reversal of interest rates in Korea and the United States is limited.